Hello. In this video, we will be going over the acquisition cost for natural resources and the asset retirement obligations associated with them. We've talked about previously different types of long-term assets, and we covered them in detail in different videos. And so in this video, we're going to be talking about natural resources. Natural resources are assets that a corporation can acquire or develop, and these assets cannot be manufactured. They come from nature, and examples of those are like oil and gas deposits, timber tracts, which think of those more as like tree farms, and we can extract mineral or mineral deposits from the ground. Okay, so the question becomes, we need to determine what is the cost of these natural resources when a company acquires them, because once we have the cost, then we're going to, as they are removed from the ground or wherever it is that we're removing them from, then we can expense them on the income statement as depletion. So the costs are, it includes the actual just the purchase price of, the timber tract or the mineral deposits, and we say assets provide future benefits, and for natural resources that means they're derived from their physical consumption. So we're going to pull them out from wherever it is that we find them, usually the ground or deep in the sea. So we can either purchase natural resources, and we can purchase and develop them sometimes. So when we purchase a natural resource, think of a timber tract. If we just purchase a land that grows trees so we can use it to make paper or whatever it is we use the wood for, it would be the purchase price and any other costs that we incur to bring the asset to condition for us to be able to use, or if we have to transport it somewhere, which obviously if it's a tree farm, we're not going to transport it anywhere. But it depends on what kind of natural resource asset a company acquires. Many times, a company will acquire a natural resource in hopes that they will discover an asset. Think of a company when they might acquire the right to drill in a certain area, and they put, drilling machines in place in hopes that they find oil or in hopes that they find some sort of minerals. And in that situation, it's when we acquire and we have to develop that. There are different costs associated with that kind of acquisition, and we're going to go through it right in here in this Word doc. There's acquisition costs, and these are all the costs that need to be capitalized as part of the natural resource asset. And the acquisition costs are amounts that are paid to obtain the legal rights to explore a natural resource. So for example, a company pays $500,000 to purchase the right to drill for oil on a piece of land in Texas. Or a mining firm spends money to acquire the rights to extract copper from a site. So once you acquire the right to even look for that natural resource, there's exploration costs, which are costs that are incurred while you're researching for that resource, such as paying $200,000 for a geologist to conduct surveys and drill test wells to locate oil reserves, or here is an example of spending money to dig exploratory shafts in mountainous area to check for gold deposits. So those are exploration costs, and those also need to be capitalized. Third, you have development costs, which are costs that are incurred after we discover that there's something there, but in order to extract that resource, right, we need to put we have to prepare the site for extraction. We have to put things in place. Those are development costs, such as installing a $2 million worth of drilling equipment to an oil field, or constructing tunnels and ventilation system in a coal mine before you can even start mining. Those need to be capitalized. The last item is the restoration cost. And sometimes when a company pays for, the right to drill or the right to look for a natural resource, and if they find it, there's a clause that says once that term is done, because companies only buy the rights for a definite term, whether it's like 3 years or 5 years or whatnot. Once you're done with that, then you have to return the land back to its original condition. So an example is after mining, a company spends $500,000 to refill their excavated pits and plant trees to restore the land. Or oil company pays $1 million to dismantle the rigs or, and clean up the drilling site to meet their environmental regulations. If you have to remove all your rigs, which is a big deal, because they weren't there when you started the project, those are called restoration costs. So all those 4 items have to be included in your cost of the natural resource. Now, focusing on number 4, which was the restoration cost, right? The cost the company has when they have to bring the land or the asset back to its original form before they started doing what they needed to do to extract their natural resource. And that cost, we probably don't know how much that is, but it is a future obligation that we have, right? It's a future liability that the company will have that they will have to pay. So whatever we determine, and it's called an asset retirement obligation, and it's a legal obligation associated with the retirement of a tangible, long-lived asset. And this is you find this often when you acquire a natural resource. It can be applied to any tangible long-lived asset if you have to restore it back to its original form. Let's go through an example. An oil and gas exploration company might be required to restore land to its original condition after extraction. So the ARO, the asset recognition obligation, is recognized as a liability at its fair value if that can be estimated. And then once you recognize that liability, you're going to credit the ARO because it's a liability for whatever amount, and the debit is going to go into the asset that you're developing, whether that's oil drilling, timber tracts, whatever it is. You have some sort of natural resource asset, and that's the amount it gets capitalized or added to the cost of the asset. There are certain things that we need to address with AROs. Number 1 is the scope, and just saying that they arise, the AROs arise from legal obligations associated with the retirement of the asset. So meaning you have a legal obligation to restore the asset back to its original form. You have to recognize or record the asset retirement obligation, the liability, as it arises. And so in some instances, a company may know that they're going to have to restore land back to its original form when they're drilling for oil in it. But another example is maybe a mining company might record the ARO gradually as it's incurred, because as the mine is dug, the liability is recognized over time to reflect the increasing impact on that land. So that's another aspect of AROs. Then we actually have to measure how much should we record, which will be the fair value of that obligation. How much do we think we're going to incur in the future? And then the last part of things to address with the ARO is the present value calculations. Because this is a future obligation, and many times it's years in the future, we're going to have to present value that amount so we can record the proper amount of liability in today's dollars. Let's go through an example of how to calculate an ARO. The Canyon Mining Company paid $1 million for the rights to explore for a copper deposit on 500 acres of land in Pennsylvania. The cost of exploring for the copper deposit totaled $800,000, so the exploration costs were $800,000, and intangible development costs incurred in digging and erecting the mine shaft were $500,000. So now we have development costs. In addition, Canyon purchased a new excavation equipment for the project at a cost of $600,000. After the copper is removed from the site, the equipment will be sold. Canyon is required by its contract to restore the land to a condition suitable for recreational use after it extracts the copper. The company has provided the following three cash flow possibilities for the restoration cost to be paid in 3 years after extraction is completed. So this is a 3-year project, and because we don't know how much exactly we're going to spend to restore the land right here to the conditions suitable for recreational use, companies will often do this probability table of, in this example, well, this company thinks it's going to cost $500,000 to restore the land, and there's a 30% probability of that amount being correct. Or it could be $600,000 and they give it a 50% probability if that's how much they're going to incur, or $700,000 is 20%. The problem also tells us that the credit adjusted risk-free interest rate is 8%. We're going to need that for present value, which you will see. So let's see, what's the cost of capitalizing the cost of the copper deposit? Well, the first thing is the purchase of the rights, right? That's the acquisition cost to explore is $1 million. We had exploration costs of $800,000 and development cost of $500,000. Now, this restoration, the restoration cost is the one where we had that probability table, and we have to calculate how much to capitalize as part of the cost. So let's see how we come up with this $468,000. What happens is you take each amount that the company thinks is they're probably going to incur times the probability percent, and you multiply it. So 500,000 times 30% plus $600,000 at 50% plus 700,000 20% gives us $590,000. So the $590,000 represents, this is a cost that we believe is the fair value of how much it will cost us to restore the land back to recreational use. But this $590,000 has to be paid 3 years from today. So therefore, right, so we have 1, 2, 3, and that's when we have to pay the $590,000. We have to present value that $590,000 into today's dollars. And the way we do that is we use the present value tables. And in this case, we use the present value of $1, right? Because this is not made in payments. So we're going to look at the present value of $1, n equals 3 because it's over a 3-year term, and the problem told us the interest was 8%. So when you look at the table for that, the present value is 0.79383. So we'll take the 590,000 times that 0.7983, and we get 468,000. And that's what we go and capitalize as the restoration cost. So now we have our total costs, right, of 2.768. We're going to debit the asset called copper deposit for 2.768. However, the amount that we pay, whatever company we got this from, we are only paying 2.3 million today. This is the 2.3 million. That's how much cash we're giving them. The 468,000 is a future cost that we will incur. We're not actually paying that to our client or whoever we purchased it, to our seller. So what we do is we credit the cash 2.3 and we credit this asset retirement liability. It's the ARO for $468,000. This is the present value of the that obligation that we think we're going to have in the future. Additionally, the problem told us about some equipment that was purchased that will be sold in the future. So we're going to capitalize that at $600,000. So debit excavation equipment, $600,000, credit cash, $600,000. So what do we do with this asset retirement obligation? Because at the end of the day, we think we're going to have to pay $590,000 when you look at that table. What we do is we're going, as every year passes by, we're going to record an accretion, what's called an accretion expense. That's a new type of expense that we're introducing. It goes on the income statement. And we're going to look at our book value for our asset retirement obligation. So we take our beginning book value times the interest rate. So 8% times 468 equals 37,469. And for the end of the year, we're going to debit accretion expense, 37,469, and we're going to credit our asset retirement liability, 37,469. What happens is, so now we're increasing our asset retirement liability by that number. So at year 2, right, at the beginning of year 2 on 1/1/20x2, our asset retirement obligation is going to be $505,000. So at the end of year 2, we're going to take that $505,000, right, which is our beginning book value, times the interest rate is $40,000. So if you look at, if we're looking year 2, like if we were doing this for year 2, we would debit accretion expense 40,466 and credit the asset retirement liability 46,666, and we're going to add that to our balance. And then at the end of year 3, we're going to take this 546 right here, right? That goes right here. 546 times 8% is 43,705, and we're going to book that at the end of year 3, just similarly to this entry. So by the end of year 3, the account balance in our asset retirement obligation will be the full $590,000. Now what happens? If the actual restoration, let's just say that at the end of year 3, we extracted that copper and now we have to restore that land back to its original form, and it actually cost us $625,000 to do that, not $590,000. Well, we had to pay for that restoration of that land, $625,000, right? Our asset retirement at the end of year 3 is $590,000. So we're going to debit asset retirement liability for $590,000, and then the difference is that we need is a debit of $35,000, and that's a loss. That's just an additional expense that we were incurred in order to pay for that land restoration. And that loss will go on the income statement and reduce our net income. Alternatively, if it cost us only $500,000, right, to restore that land, we would credit cash $500,000. We would still debit our asset retirement liability by $590,000, but in this situation, we would have a credit for a gain. We wouldn't have this $35,000. We would have a credit for a gain for $90,000, and that would also go on our income statement as income. So you're going to debit the asset retirement for the balance, credit however much cash you paid for the actual restoration, and the difference will be a gain or loss.